Thank you, everyone, for joining this morning. We're pleased to take you through our interim results for 30th of June, 2022. Before I begin, just given the passing of Queen Elizabeth, the week of national mourning, just condolences. I think it would be appropriate to pass to the royal family and, of course, the nation that's going through this transition. Also, just to note, thank you to the board for all your support. As you'll see in the results, and as you've seen in the RNSs and the frequency of some of the RNSs, it's been a very active 6 months, so we appreciate their support. I'm Tor Johnson. I look after the DGI9. I'm joined by Isabel Gunn-Brown, our Chief Financial Officer, and Andre Karahalu, an investment director in our team. As part of a much broader team of digital infrastructure experience and infrastructure investment experience with a track record of over 300 billion. So just to take you through some quick highlights that we'll go through in more detail. Just on the left side of the slide, you'll see 30th of June. And on the right side, we're saying pro forma, and that's pro forma for some of the acquisitions we've made in the period and acquisitions that have closed subsequent to the balance sheet date and expecting to close in the coming months. So just on the 30th of June, it's 105.13 pence per share, the NAV. The operating cash dividend cover is 53% for the end period. And the cost of capital, or the cost of equity, and we'll take you through the approach there. It's been a slight change. It's increased to 13.7%. So pro forma, where we are as a portfolio, we'll take you through the detail on this, is 223 million of EBITDA. Implied as a cash dividend cover is 186%. And just where we are trading, and this is as of yesterday's close, roughly that implies a 13.2 EV/EBITDA multiple. So just operational highlights for the period. So increase in revenue in Verne Global, first half of the year relative to the last year of close to 30%. Increase in EBITDA of 45% for the similar period. Just a few highlights that you may have seen. Just one was the announcement we made earlier in the year, the capacity expansion that's going to plan, continuing to see an increase in demand for that capacity. We've also seen an increase in expansion of capacity on the existing facilities from existing customers, particularly in the financial services industry. We continue to see, and as Andre will talk you through, a real demand for this low-cost energy, high energy security, high renewable product that ultimately we're offering. So very well positioned in this current market. Aquacoms continue to see growth as well. So 10% increase in revenues for the like-for-like period. And 2 new systems came live in the first half of 2022. Also during the period, just as a further step of progress on the EMIC-1 system, we've signed an agreement with Telecom Egypt, and that's for crossing Egypt terrestrially. We've also signed an MOU with a cable called Celtic Norse. It's a new cable that will run between the west coast of Ireland and Trondheim, Norway. Again, when you look at the energy map, you'll understand why that cable is being built. So just as a reminder on our strategy, what we're focused on, data centers, where the processing, storage of the internet occurs. It's the brains of the internet. That's connected to the backbone, where 98% of the world's fiber data is carried, subsea fiber. And finally, connecting to the end users, the capillaries, terrestrial fiber, and wireless networks. So just to highlight the pie chart on the upper right, that is pro forma for where we are today. So roughly 44% data center exposure on a NAV basis, 34% wireless, and 22% subsea. And then, of course, as we've targeted and outlined over the long term, we'd expect that balance out and bring in some terrestrial fiber exposure as well. So highlights for the period from IPO to September 2022. So 900 million equity raised, over $1 billion invested, RCF in place of 375 million. We've been paying the 6p dividend, and we'll outline the pipeline. But just to highlight, and importantly, through the period that we're talking about, a few acquisitions, of course. We first of all, we announced the capacity expansion at Verne, and that increased investment. Host Ireland, the Irish fixed wireless access network, Volta data centers, and then closing subsequent to the period that we're referring to, June 30th, Ficolo, and then also Arqiva, which will close in the coming months. So overall, 8 acquisitions. We'd identify 4 best-in-class asset platforms. And what we mean by that is these growth platforms that we can invest more into across the various subcategories. And then again, a high proportion of these are bilateral, and we continue to see an acceleration of that, just as we continue to both grow our network, and network being all the different categories, as well as our people, and that 300 billion digital infra experience. We'll continue to see the bilateral element of our platform accelerate. So where we are pro forma for the portfolio, importantly, just the weighted average contract recurring revenue. So it's 7.7 years contract length on average across the portfolio. Nearly 70% of that has some form of inflation protection. And importantly, nearly 58% of the total recurring revenue is RPI CPI linked with no cap. Given we are a high fixed cost infrastructure business, we'd also very much highlight the fixed uplift as well as being important as translating into the bottom line well above the inflation impact. Finally, the currency exposure is, as you'd expect it, so euros, dollars, and sterling predominantly. And then finally, the EBITDA snapshot, so 223 million. Again, this is pro forma for where we are today as a portfolio, balanced across the 3 subsectors. So just to translate that into a cash flow per share. So starting end of December, we were at that 39% number. Today, we're announcing the 53% number. If we bridge that to the underlying cash flows that we're seeing from the investments, particularly with data centers, you see that, so built capacity, so built assets and sold capacity. We use run rate for this. And then also doing an LTM on the additional acquisitions, it brings you through to the 11 pence per share. And now I'll pass to Isabel to take us through the financial overview.
Thank you, Tor. So I'd like to take you through a few of the financial highlights at the 30th of June. Our IFRS NAV per share was 105.13 pence, which is an increase of 7.3% since IPO. During the period, we've declared dividends of 3 pence, which is in line with our annual targets, and our market cap of 897 million represents a premium of 5% on our NAV. Our IFRS investment valuation of 825 million includes fair value investments of 642 million and 183 million of cash held in the underlying subsidiaries, of which 120 million has been deployed since the period end into Ficolo. Our annualized shareholder return is 13.3% and is calculated on a share price performance plus reinvested dividends. Our annualized total return is 10.7% and represents NAV growth plus dividends paid. Earnings per share of 3.43 pence is calculated on the weighted average number of shares in issue during the period, and the ongoing charge ratio of 1.09% is still below forecast but has increased since 2021 as the investment management fees increase in line with deployment. So turning to the statement of comprehensive income, our fair value gain on investments represents the change in valuation on Aquacomms and Verne. Since IPO, the fair value gain on price paid for Aquacomms has increased by 28% and Verne by 15%. The 1.4 million of distributions were from Host Ireland and Sea Edge data center lease income, We expect distributions from the portfolio companies to increase during 2023 with the post-balance sheet acquisition of Arqiva and the completion of reinvestment into Aquacoms and Verne. Our ongoing charge ratio is a calculation of the operating expenses of 4 million for the period, expressed as a percentage of the average net asset value. Dividends declared of 3 pence have been expressed as a percentage of the portfolio's operating cash flows on a look-through basis for the 6-month period to the 30th of June. This does not include the operating cash flows of our post-balance sheet acquisitions, Arqiva and Ficcolo, which will increase the look-through dividend cover for the second half of 2022. Turning to the statement of financial position. Investments at fair value include the investments of 642 million and cash of 183 million, which, as noted earlier, 120 million has been deployed since the period end. The cash of 30 million is retained in PLC for working capital, and our net assets of 852 million represents our IFRS NAV of 105.13 pence. Turning to our net asset value bridge, you can see from the 31st December, the net asset value per share of 104.6 has increased by the valuation of Aquacoms and Verne, has slightly reduced by the operating loss, and a small increase from the accretion in value from the premium on the equity raise in January, to provide our closing net asset value per share of 105.1 pence. And just looking at the total return since IPO of 13.4%, this is made up of the growth in NAV and 6p dividends paid to date. Thank you. I'll pass you on to Andre to talk through the portfolio.
Thanks, Isabel. So our valuation uplift on an IFRS basis has been 10.6% since year end. It's important to note that these are based on cash flow forecasts from management projections, and those long-range plans are only reset annually. Aquacoms and Verne, as already mentioned, are the only assets that we've been revaluing at this interim period. All the other assets have been held at cost. So EMIC is a development asset, Sea-Edge UK is primarily a real estate asset, and Volta and Host only completed recently. The methodology has been refined to bring us more in line with peers, and also positioning the portfolio in anticipation as we add asset co-level debt during 2023 at an Aquacoms and Verne and other data center operator level. So we've shifted from a free cash flow to the firm basis to a free cash flow to equity. And that means we've replaced WACC with the cost of equity as the discount rate component of the valuation. That cost of equity has increased from 13.2% in December at year end to 13.7% now. The primary component of that shift has been the increase in risk-free rates. If you recall, Aquacoms and Verne are both US dollar denominated assets, and the Federal Reserve rate has increased from 1.9% to 3.2% in this period. There's another component that we'd like to talk about, and that's the company risk premium. So as Aquacoms and Verne are still small mid-cap companies, we have a company size premium included, and there's also a company-specific risk premium. We'd expect both to decline over time as the companies grow and as they mature, and as the management teams evidence their ability to deliver on the long-range projections that they reset every single year. So once again, we expect that to reduce over time. We believe that these costs of equity is very conservative, and the valuations are conservative, especially when you look at relative to peers in the data center and the wireless tower space, which are around 6.5% cost of equity. That applies similarly when you look at the pro forma EV/EBITDA multiple. Our trading multiple, as Tor mentioned, is 13.2 times. And when you look at our listed peers in the data center and the wireless tower space, they're in the low 20s. And then recent transactions around the 25 times EV/EBITDA multiple. So once again, we feel that we're in the range, in line, but conservatively valued relative to our peers. Now moving to the portfolio. The important thing to note here, so as Tor mentioned, we have 4 growth platforms. This was what we set out to do, and we talked about it from from IPO, we said that we wanted to invest in subsea fiber. We were going to leverage the connectivity and the customer base that would bring us. And we have Aquacoms, which is fundamentally works in global data center to data center hub interconnectivity. We talked about a Nordic data center platform. DGI9 now owns 15% of the Nordic data center market through 4 different sites and campuses across Iceland and Finland. And I'll talk about that on the next page. We have a Sea Edge platform that we're growing globally. And in wireless, we'll talk about it, but we have an Internet of Things platform and a fixed wireless access platform that we're looking to leverage throughout the United Kingdom and beyond. The important thing to note is we have best-in-class operators in each subsector that we target, in subsea fiber and data centers, in wireless, and we will in terrestrial too. And that differentiates us from other funds who might invest in multi-asset platforms. We invest in best-in-class operators and then unlock synergies and convergence between each company. I think one of the big competitive advantages for D9 is that customer relationship. So with subsea fiber, we partner with the biggest procurers of digital infrastructure in the world, and mainly global tech, Google, Facebook, Amazon, Microsoft, Apple, but then also the global telco carriers. And having visibility of where they see demand for digital infrastructure coming over the next 5 to 10 years puts us in a great position. And being in the room with them while they have these discussions is a great advantage for D9. And we can use that knowledge to unlock convergence within the portfolio in data centers and in wireless. And then the overriding theme, the reason we're called D9, that 9 is from the UN Sustainable Development Goal 9. So what that does is focus all of our investment activity on improving connectivity around the planet and on environmentally sustainable investments in digital infrastructure. And that includes decarbonization. And some of the metrics that we published at the annual report evidence this. So 97% of our energy consumption throughout all of the portfolio is renewable. We emit very, very small amounts on many metrics, very small amounts of emissions relative to our peers in the US and globally. And as I'll talk about now with data centers, our data center portfolio emits less than 1.6% the emissions of equivalent UK data centers. So the Nordic DC platform. So our aim right from the outset has been to shift energy intensive computation, those applications that need a lot of energy, but that are latency insensitive, shifting them to areas of abundant green energy. So something like only 5 to 10% of energy of data sets that are in Frankfurt, London, Amsterdam, and Paris actually need to be close to the end user. Around 90% of those data sets are latency insensitive. And the component that is energy intensive, our aim and our mission and what Vern and Fickler have been doing is encouraging enterprises throughout Europe and America to migrate those applications that don't need to be close to the end user to these areas that have the lowest PUEs, power usage effectiveness ratios. In Europe, 1.19 is our data center average. To put that into perspective, the target for the industry as a whole globally by 2030 is 1.3. So we are already well below that. As I said, we emit dramatically lower emissions than any other comparable European data center. And the electricity that we power, that when I say moving to areas of abundant green energy, this is baseload renewable energy from hydroelectric and geothermal. And in the case of Verne Global, they have a PPA from the national grid equivalent of around 30 euros per megawatt hour with a fixed uplift of 2.5% year on year to put that, and that's for a 10-year contract. So they've got incredible visibility. And what that translates into is an 80 to 90% power cost saving, bearing in mind customers and data centers pay for power. So we can offer almost a 90% total cost of ownership saving by migrating those energy intensive data sets. So when you look at customers who are in a Slough data center or in a Parisian data center, they can not only have a cost saving, a power saving, when you look at power prices of 300 euros a megawatt hour in the UK, 600 in Germany and versus 30 in Iceland. They can not only have that saving, they can also have a genuine sustainable solution. And that is what the D9 platform is offering. So we have 63 megawatts of IT capacity in development operation in Iceland and across our 4 platforms, campuses in Iceland and Finland. Importantly, we have space for 190 megawatts on those sites. So we've got another 135 megawatts that we can build out. And we can build that at a very accretive multiple for D9. And we are building it at a very accretive multiple for D9 at a sub 6 times EV/EBITDA multiple. And just taking you through some of the metrics there, we can build a roughly 6.5 million a megawatt. And when that is sold, that's sold at 13 million a megawatt in terms of revenue. And that translates to about 1.1 million of EBITDA generated per megawatt. And that's a sub 6 times EV/EBITDA. And if we add in a bit of leverage, as we talked about in the back end of 2023, that's a very high and accretive levered yield that investors can expect to receive from D9 in the coming years. The flip side of the latency insensitive data sets that we're migrating to the Nordics is Volta, which is the Central London Metro Edge data center. If you recall from IPO, we talked about 3 types: Nordic DCs, Metro Edge data centers, and Sea Edge. So with the Metro Edge, we acquired Volta in the period for £45 million. All of our data centers have been acquired for sub-market rate multiples. Vernon and Ficcolo were acquired for around 20 times EV/EBITDA. Volta we acquired for just under 17 times. Most importantly with Volta, when I say it's the flip side, this is for the latency sensitive applications, the things that need to be sub 5 milliseconds close to the end user. And Volta is the most connected independent data center in London. The only data centers with better connectivity are the global behemoths, Digital Realty, Equinix, and Telehouse. And then there's Volta. And we're going to be looking to unlock that. It's a slightly different customer base to what we see in the Nordics. Nordics, in Verne, we have effectively supercomputing, AI machine learning customers at the cutting edge of technology, high performance compute. In Ficcolo, we have ultra sustainable large enterprise who want that co-location in a Nordic facility. And then in Volta, we have more of the creative sector. We have telecommunications carriers, obviously because of the interconnectivity, and financial institutions as well. And this was not part of our business case at acquisition, which was standalone. What's happened is that Verne Global have come in to lend their decades worth of expertise at the Volta facility and have immediately unlocked it as an on-ramp into our Nordic data center solution. For example, there's a migration from, as I said, those energy intensive, high power cost slough data centers through to that 90% power cost saving that we can achieve in the Nordics, together with that genuine sustainable advantage. With the Sea Edge data center, these are landing stations. We have access to them as part of our subsea network. At this particular data center in Newcastle that we own, there are 2 cables that land there. The first is the North Sea Connect cable that is owned and operated by Aquacons. The second is the NO-UK cable that's operated by Aquacons. And both plug into D9's North Atlantic Loop subsea fiber network. So what that means is, from that data center in Newcastle, we connect England to Denmark, Norway, Ireland, and the United States of America. So it really does tie in with that United Nations Sustainable Development Goal 9, improving connectivity in previously underserved parts of the world. As I mentioned, this is a global roll-up strategy. This is the first of potentially 5 to 10 different assets that we will acquire in the coming years. Subsea fiber, we call it the backbone of the internet, and that's because 98% of all international internet traffic flows through it. There wouldn't be a global internet as we know it without subsea cables. DGI9 has 32,000 kilometers of cables in operation and in development. We're building a new route in partnership with Facebook that is nearing completion from Europe over the Middle East to India. That will be the first modern cable on that route. And in fact, the 3 cables that we have in the transatlantic market are 3 of the 4 most modern cables. It takes 5 years to build one of these cable systems. And so we have a great advantage in terms of lead time because, and we're also planning with the likes of Facebook, Google, and Microsoft, the biggest purchasers of subsea capacity in the world, for future cables in the Atlantic and beyond. So, for example, A4, 5, and 6 are all in development and planning as it stands right now. So 95% of our revenues come from these global tech and global carriers' biggest purchases. But the true magic of subsea cables is that we can expand the capacity of these pipes effectively without ever touching them. Once they go on the seabed, they stay there for at least 25 years. But by changing the transponders or the lighting cards at either end, we can increase the capacity. And as those legacy cable systems, bearing in mind we have 3 of the newest cables in the Atlantic, as those old cables that were laid in the early noughties come offline, and there'll be a 40% capacity shortfall by the mid-2020s, we can expand our capacity to absorb that. And so we're very well positioned going forward. On this new route over to India, the prices that we can charge there are 10 to 15 times higher than we can get in the transatlantic market for just 3 times the cost of building that cable. And that price is even lower than customers and enterprises are currently being charged on that route. When that cable is complete, it's the back end of 2023 or Q1 2024, it's called ready for service, but the pre-sales will be in 2023. Our whole network will connect 3 billion people, very much tying into that UN Sustainable Development Goal 9. The important thing is anywhere that we expand subsea fiber automatically opens up new opportunities for DGI9 to invest in other digital infrastructure components. The other asset that we acquired in the period was Host Ireland. This is the leading fixed wireless access enterprise broadband provider in Dublin. They're very high dividend yield, very good management team, and we're looking to unlock them because there's a huge amount, they've been up to now capital constrained, and there's a huge amount of demand from other, from tier, not Dublin, but from tier 2 cities for this sort of access. And the reason being is that it's roughly 9 times faster to deploy and 6 times cheaper to deploy than fiber. And so when you look at those pockets of digital divide that have sprung up throughout the UK and Ireland, and the long wait time before fiber is deployed to some of those locations, fixed wireless access is something that we can deploy very quickly and very cheaply in those markets. But even in situations where fiber already exists, such as in Dublin, fixed wireless access provides a very resilient and robust, uncontended symmetrical service, so 2 gigabits up and down speed that a lot of enterprises find very attractive. In fact, Aquacoms is a customer of Host Ireland and has a fiber network on the side. So this is something that we consider another growth platform for us, and we'll be looking to leverage this throughout the UK and Ireland in the coming years. Now handing back to Tor for Outlook.
Thank you, Andre. So Arqiva is the last acquisition we announced. We're very excited about it. There's 2 main reasons why we believe investors should be excited about this. One, the cash flow. We've talked about the inflation linkage in this asset, but the high cash conversion in this business. We believe that strong underpin in an income yield is very positive, particularly as we mix it with our growth platforms. But there's another reason, and that is because there is actually a really exciting growth platform within this business, the utilities and IoT platform. And this, after the summer we just had, is actually perfectly placed to help water utilities turn their networks into smart networks and manage leakage. That's at the heart of their IoT network and the smart metering connectivity. So fantastically placed in this world we're in, and a fantastic fit for our SDG 9 initiative on connectivity and environmentally sustainability. We'll walk through the debt structure, but just overall, so 52% equity stake. The long-term revenue visibility is reflected in that nearly 4 billion contracted order book. And the essential services that this provides, coverage across 90.5% of the UK population, still an essential service for large parts of the UK population. And then on the IoT side, already a scalable national network, ultimately 12 million on their smart meter connectivity network, and 50 million daily data points already on their smart meter network. And they're poised for a lot more growth. There's still a lot to do in the water utility sphere. So overall, this is just to reflect on the 2 different business divisions. media distribution, and then the IoT and smart utility side. So media distribution, 290 million EBITDA, and then IoT and smart utilities are 42 million. We outlined the different typical contract lengths, but ultimately it's a mix of not just the utility-like assets on the media distribution side, but also essential services that are poised for further growth and a future with IPTV. IoT, of course, is something that we're very excited about. We've seen this across other businesses, and what we really like about this business is it's solving a social problem with water leakage, particularly also to provide a connectivity solution for metering. That ultimately is at the heart and at the forefront of what some of the activities that the water regulator is focused on, and particularly to help manage down that leakage rate. Next slide. So just to go through on the left side, so unfortunately, because of the publicly traded bond on Arqiva, we can't, and the company hasn't announced their results yet. So we're still tied to the FY21 numbers, but very high cash conversion. We're not expecting a significant change to any of this. It will be and perform as you'd expect, particularly because it's such a high proportion of contracted revenues and with the inflation protection and built. On the debt side, just to focus on this, so this is the asset level debt. So this is the investment company level debt. Again, it's non-recourse to D9. Just to highlight, so if we go down to the bottom, so it's nearly 6.5 times of leverage, but this is very much in line with the total industry average of net debt, around 6.3. Ultimately, and just to point out, so the acquisition financing, that's what we call the vendor loan note previously, but it is acquisition financing that is long-term in nature. I point out a few points, and it's just highlighted in the bracket at the bottom. So this is a very sustainable capital structure. Only 13% of this total D9 asset level debt is going to come up for refinancing within the next 5 years, and that's all BBB rated. So again, only 13% of the total debt of the D9 asset level debt is coming up over the next 5 years, and ultimately that's BBB rated. And as we are looking to delever this business over time, we'd actually expect a lot of that to just be naturally retired. Overall, the duration is nearly 8 years. And that's, again, given the refinancing that the company announced on the junior bond, but also given the acquisition financing structure we've put in place. So just on pipeline, our focus very much is, and as Andre touched on, we are settling into these 8 assets, really focused on operational improvement and the growth opportunities within each of them. But ultimately, we still are in the market. We still see a lot of bilateral opportunities in particular. And so we do have a pipeline. And ultimately, we are biasing again towards the existing portfolio, but we do see opportunities out there for further diversification and further growth. And as outlined, a big proportion of which, of the 310 million that we identify in the near-term pipeline, is bilateral. And with that, I'll just end with a summary. So again, it's a very large asset class. We've identified that before. There's a lot more growth. We believe that's 400 billion per year. We're perfectly positioned right now, we believe, with our growth assets to continue to see organic growth within our businesses. Convergence and that broader relationship set is driving a lot of opportunity for us within each business. And that's part of the operational improvement that we're focused on, but also, of course, also leading to potential pipeline. Overall, we're still focused on that 10% total return, paying a high proportion of which in income through dividends. Total shareholder return in 2022 of 13.3%. And again, our big focus, 2 elements on being a specialist manager in digital infra. One is that depth of expertise and the breadth of expertise and the relationships that brings, but also our focus on the SDG 9, particularly obviously with respect to digital infrastructure, focusing on assets and investments that were improving connectivity and improving the sustainability. And as you'll see in each of the assets, we're driving a mission forward on each of these aspects, or